Hi, it's Rich Ottenoff here. This is the first video of the YouTube channel to start to explain the basics of the financial statements that you're going to encounter when you're running your business. So my company, my experience is 28 years in the coffee roasting business, in the coffee business, running cafes and primarily coffee roasting. The statements are the same. And so the examples I'm going to use are all coffee related examples, but you can easily transfer the terms and the basics into your business. So we're going to start with the balance sheet. And the balance sheet keeps track of who owns what. And as the name implies, the balance sheet is always in balance. And so this is going to be a very short video, and we're going to take this whole journey very, very slowly so that I'm certain that you understand the concepts before we move on to the next video. So balance sheets are broken into two parts, two sides, assets and liabilities. What you have and who owns it. Those are really important because not everything that you have belongs to you as a company. We take bank loans, we borrow from family, friends, or accounts payable. So you receive items from a supplier and you pay for them later. So it's really, really important to keep track of these things accurately. And so for our first entry, we're going to assume that you, as the business owner, are investing some of your own money. So in our case, we're going to say you as the business owner are bringing $20,000 into the business. And so we're going to enter that on the assets side of the balance sheet. Now, on the other side of the balance sheet, remember, it always has to stay in balance. Liability. Who owns that $20,000? Well, you do. You're the owner. That's the owner's share. That's the owner's equity. So on the opposite side of the balance sheet, we put $20,000. That's the owner's equity in balance. So this is very, very simple, easy to understand. Now let's say that you're also getting a bank loan. And to make things simple, let's say you're borrowing $80,000 from a bank. The $80,000 goes into cash, so now we have $100,000 on the asset side. That's nobody disputes that. You've got your $20,000 from you, and you've got $80,000 in cash from the bank. On the opposite side, now that's a bank loan payable. That's not really your money, that's the bank's money. And so we have the bank as a liability. We owe them $80,000. And the equity that you have put in, the $20,000. So now the total assets are $100,000 in cash, and the total liabilities, $80,000 you owe to the bank, and $20,000 the company owes you as the original investor. In balance. So for your business, maybe you can take a moment before we move on to the next video. Now, I'm posting these videos, maybe I'll do one a week. That's the goal. So you've got a week to think about, okay, Who is your original investor? Maybe it's you, maybe it's family and friends. You place that money on one side of the balance sheet. And on the other side of the balance sheet, it's listing who owns it. Family, original investor. Maybe you have a bank loan, but those two sides have to equal. They always equal. So think about that for a week, and we're going to move on to do some more entries with the next video. Again, slowly. The whole idea of this is that we don't just plow through this. I want you to understand so that when you look at a balance sheet at the end of your year, when your accountant presents it to you, you 100% understand what's going on. We're also going to talk about income statements later on, but first the balance sheet, because when you start a business, you start with an investment. You don't start by making money without an investment. You can't, you know, it doesn't work that way. So we'll always start with the balance sheet and keep track of what you have and who owns it. The other important thing to remember, and if you read anything about financials, they always say a balance sheet is a snapshot in time. It's not a moving thing. It's, as of today, you know, what does our business look like? So think of the balance sheet as a photograph in time, just a moment in time. The income statement is more of a movie. It's moving and it's always changing. The balance sheet is just a picture of your business at that moment in time. And really, most people take a look at their balance sheet quarterly, semi-annually, and then once a year. So let's just focus on what we talked about earlier. Original investment, that's you, owner's equity. And then if you happen to borrow any money, that money goes into the bank. We haven't spent it yet. It's in the bank, in your checking account, 20,000, 80,000. But on the other side of the balance sheet, who owns that? 20,000 is the owner's equity, 80,000 you owe to the bank. And we'll see you next video, and we're going to move on to some more entries. Thanks a lot for watching. If you have any questions, throw it in the comments, and I'll get back to you right away as soon as I see them. Okay, thanks.